everyone, and thank you for joining us once again here at Seafried and Brew for our economic briefing. I am Jamie Sumner, Chief Analyst here, and for this briefing we want to review over the projections from the IMF in terms of economic growth for the United States and the world at large, and then we're going to refresh ourselves with the Fed's projection for 2020 in terms of economic growth, that GDP number, and we'll look at also the Conference Board's projections. So we'll see what they have some consistency in these projections for 2020. We'll look at then the expectation of inflation, and then from there we'll make some final comments regarding where rates are right now and in terms of where they could go over the next couple of months. So when we look at the IMF projection coming out on the 16th of January, we can see that overall for 2020, the IMF is suggesting or projecting a 2% growth in GDP for the United States. This is down from their projection of 2.3% in 2019. So overall, we continue to see this slowdown in the overall economy for the United States. However, when we look at the world output, we can see the world output here going from a projection of 2.9% in 2019 up to that 3.3% in 2020. So as a world, we're actually seeing those numbers increase, and that's primarily due to those emerging emerging economies or developing economies, projecting an overall growth rate of 4.4%. So we can look at that and say the United States is starting to see that a little bit of a slowdown in terms of the overall GDP, and we see that also in 2021 where we have the projection at 1.7%. So we continue to see the slowdown in the projections at the IMF. Now, when we look at the Fed, we can recall, we saw this last month, the Federal Reserve looking at a 2% projection in 2020 and a 1.9% in 2021. So similar numbers coming down in the same fashion over the next couple of years. And in fact, when we look out to 2022, we see that number for that GDP growth coming down to that 1.8% mark. Very similar, same numbers we saw back in September, and then we see them again in December. Now, when we look at the Conference Board numbers, interestingly, you look at 2019 annual projections at 2.3%, and then in 2020, 2.1%. So we continue to see that slowdown, not as much on the Conference Board's numbers, but we do continue to see that slowdown. And that's something that has been consistent throughout time, is these numbers continue to show the overall slowdown in the U.S. economy. That's not to say it's a recessionary issue that we're looking at, but just that overall growth is slowing down. Now, how does that weigh in on interest rates? Well, when we look at interest rates, think when rates are stable, growth is going to be stable. And when we see the overall slowdown in the GDP, then we're going to start to see that reduction in the rates. And right now we're at the stable level. I think where we are now around that upper 170s, 180s is primarily where we're going to be. We could see, if we have some good economic numbers coming out, we could see some of those, that 10-year Treasury maybe get as high as 2%, but I don't think it's going to go too far beyond that. If it does, I would say that would be a buying opportunity at that long end. But the risk, of course, right now, what we see is that risk to down rates coming down. When we look at the fourth quarter GDP, we can see the GDPNow put out by the Atlanta Fed coming in at 1.8% for that fourth quarter. Next week, we will be getting the advanced estimate for GDP, so that's exciting. Somewhere around 2%, I think it's going to come in at. That's at least what we're projecting. We see Bloomberg economists, that forecast is looking around 2.1%. This Atlanta Fed at 1.8, a little lower than what we're anticipating. But when we look at that and take that in consideration, we look at that five-year forward inflation expectations. This has come down a little bit over the past couple of weeks, just something to keep an eye on. That would be an indication that that 10-year treasury, those longer rates, are going to stay right where they are, potentially come down a little bit. So when we think about our asset yields, which are priced out typically on the long end of the curve, we can see those asset yields begin to stabilize, hopefully in the end of the first quarter in 2020, and we'll see if we can get some relief on this margin compression, which I think is going to happen through the second and third quarter of 2020, and how that's going to impact the overall earnings throughout this time period, particularly for the community banks. But that's what we have for you today. We look forward to reporting to you next week on that GDP number and the Fed. They will come out with their expectations on interest rates, and right now we're forecasting they're just going to stay where they are in terms of their Fed funds rate. No real change there, but we can still see in the market in general an overall lower level of rates on that short end of the curve, which would help us on those deposits, particularly those CD rates that had gone up throughout the first part of 2019. Well, we look forward to seeing you next week. Have a great week, everyone.